If you're a Canadian investor, then I need to talk to you because me and you and every other Canadian investor has one stock market trend we really need to understand right now if we want to make any money or even protect ourselves from downside risk this year. And it's all about interest rates, which everybody hates talking about. I'm going to break this video up into two pieces really quick. I'm going to talk about what happened, how we got to where we are, sort of the background, and then I'm going to talk about what's maybe going to happen and how we need to react and the trend that will play out this year that will dictate a lot of the Canadian economy. If you're a Canadian investor, super important. If you want to skip over the bit where I talk about the past, feel free to do that and get to the good bits. Keeping this quick, respecting your time here. Obviously, we remember inflation. We remember how it shot up coming out of the pandemic. We remember how everybody used their stimulus money to, buy meme stocks and cryptocurrencies and NFTs and all of that. And how inflation shot up. And so central banks, of course, raised interest rates quite high. Middle of 2023, we sat at about a 5% interest rate here in Canada. The US went even higher than that. And then as inflation dropped, we also were able to drop interest rates. The current interest rate in Canada is about 3%. In the US, they have not dropped their interest rate quite as much. So that's where we are today. Going forwards, we have a couple of interesting things maybe playing out. Now, TD has predicted that interest rates will drop another 0.75% in 2025, which would put us at just over 2% by the end of the year. And we could see it as low as somewhere in the ones, depending on what happens. And the reason I keep saying that is because it is a simple fact. The Canadian economy is not doing well. As a whole, Canada's not doing well. We talked about this in my video yesterday about National Bank and BMO, where I talked about how National Bank's personal banking segment really suffered. And that is true with BMO's as well. Their personal banking segment suffered. And it is likely to be true when we get reports coming out later today from all of the rest of the Canadian banks. The Canadian consumer, the Canadian person, the Canadian economy, the base unit of the Canadian economy is suffering. And so the logical thing the Bank of Canada could do to help that person out is drop interest rates, because then that person is able to access credit at a cheaper price. Things like mortgage renewals will become cheaper. People will be more able to access more capital to spend more money, seemingly boosting the Canadian economy. The problem is all of the stuff going on this year has meant that is now more up in the air than ever before. While it is logical for the Bank of Canada to drop interest rates, I don't know that it will happen. And I think whatever does happen, it will be critically important for your portfolio. Now let's talk first about what happens if interest rates do go down, as they are predicted to. Now the first problem with that is something called the interest rate differential, which is just the difference between the Bank of Canada's interest rate and the US Federal Reserve's interest rate. In the United States, they have not dropped interest rates as fast, and therefore people can still get a high interest rate return on a US government bond. Now, these can be short-term treasury bonds, these can be longer term, but the ones that are the most lucrative, these short-term treasury bonds that everybody from Warren Buffett to grandma is buying, have a fantastic return right now, which makes it really enticing to hold US dollars. Now, for an American investor, that'd be no big deal. You're used to having your currency be the global reserve. But as a Canadian investor, I get paid in CAD. I get paid in Canadian dollars. I spend Canadian dollars at the store. And I invest in Canadian companies in Canadian dollars. And because the Canadian interest rate is lower than the US, it is less enticing for investors, and I'm talking big banks, to hold CAD. And the Canadian dollar is already weak. If we see the Fed hold its rate, which it has indicated it wants to, and we see the Canadian Bank of Canada drop our interest rates, we could see the Canadian dollar devalue even further. Now that will impact your investments, particularly if you are buying USD investments. So if you're getting paid every month in Canadian dollars and buying a US stock on a US exchange in US dollars, obviously your money's not going to go as far. But even bigger, If you are looking to sell Canadian dollar denominated investments on the TSX particularly, but also a house or whatever other physical asset, you could lose actual value because of the currency risk. And that's a huge, huge problem for Canadian investors. We are not Americans. We do not have the luxury of having our currency be the global reserve. And so we need to be in a position to recognize if I'm selling Canadian assets right now, I might lose out. I personally am bullish on the Canadian economy. I think things will get better. I think Canada is a great opportunity right now because prices are low. And you will be able to get more investments for your money right now. But that will not always be the case. That's my significant, serious belief. That is the reason for this channel, is that Canada is a good place to have your money. I think this country has a strong economic future. But I am not necessarily you. My beliefs do not reflect yours, and you might not agree. And if you are investing in US dollars, you're going to have to think about the fact that Canadian dollars, if you get paid in Canadian dollars, don't go as far. So serious impacts to your investments when the interest rate goes down. If the interest rates go up, if they see inflation ticking back up, like they have in the United States, and they decide that it's time to raise interest rates to stop inflation in its tracks, that they will not allow it to rise again, that could be massive for your investments. First off, any Canadian business that is interest rate sensitive will suffer. We are talking REITs because they have those huge mortgage loans. We are talking telcos because they hold huge amounts of debt. We are talking even energy companies because they have huge amounts of debt that they use to develop new infrastructure. All of these companies will suffer, but also growth companies, small caps, will suffer probably the worst out of everyone because they struggle in higher interest rates environments to gain funding to grow. And they find themselves getting cut down in value. And so your investments in these companies in Canada might suffer. You might also see that some retailers, some consumer discretionary stocks also suffer because the Canadian consumer that we talked about earlier is already struggling. And if interest rates go back up and we see them climb, we could see a lot of people that can't afford to be consumers at Canadian businesses. And that could come at a critical time because the boogeyman of the Canadian economy is tariffs. The Canadian economy is so tied to the US right now that if the United States puts blanket tariffs or just like a couple key tariffs on things like energy and resources, then we could see the Canadian dollar drop and interest rates go up to combat inflation because Canadians are already suffering. And if the cost of goods here go up with counter tariffs or alongside whatever other economic struggles, well, we're going to be in a really seriously difficult position. And so it is critically important for you as a Canadian investor to watch the interest rate story, understand the story, decide how it impacts your portfolio, and make the best decisions for yourself. That's what I'm going to be working on. I'm going to be watching this story as it develops throughout the year, and I will try to update you guys. But it's also really important that you, as a Canadian investor, decide for yourself. How is this going to impact my portfolio? Whichever way it goes, don't predict the future, just prepare for it. How are you going to prepare yourself? How are you going to be in a position to win? And obviously, you know my advice, long-term thinking, always. Buy the dip, always. That is how I invest. I fundamentally believe that is the core principle of an investor, is that you are trading short-term for long-term. And that is the idea of investment with compound growth over time. That is what I'm going to be investing for. That is how I'm going to prepare myself for whatever might come out of the interest rate story in Canada in 2025. But it's also important that you take a look at this trend and decide how you're going to prepare yourself. If you enjoyed this video and you like talking about investing in Canada and otherwise, please do subscribe to the channel. It makes a huge difference to me and it doesn't cost anything. And if you could like the video, that would also be massive. With all that being said, I hope I see you in the next one.